And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The ESG market is in its infancy, but it's growing fast. But there's still a lot of controversy over exactly what constitutes environmental, social, and governance ESG rules. Joining us now, Doug Peterson, President and CEO of S&P Global, one of the world's largest providers of indexes, including ESG indices and the Dow Jones Index, and Todd Rosenbluth, my old buddy. He's head of research at ETF Trends. Doug, you've just released a statement on what you think the essential principles of ESG should be. Everyone is worried about the environment, but nobody can agree on what these terms are. ESG. What are you actually proposing here today?
What we're proposing is a standardization of ESG disclosure, ESG funds. What we really look at is this theme about transparency and impact, that we should be providing a way that the market can have a set of standardized information that can be used to make decisions for investors. One of the things that I could say is that the train has already left the station. People are very interested in this. There's large value of funds that are out there, of people that are interested in investing based on purpose, based on value.
Yeah. So you've emphasized the essential elements of what's needed here. Transparency is one of them. A description of the impact on society and the environment, and the risk associated with things like climate change. This seems to be what they absolutely have to have here. Now, what do we do to advance this? Where do we go from here? How do we make this more real?
One of the best things we can do to advance this is to have a dialogue across the markets, both with investors as well with securities regulators, like we heard today from the SEC, as well as a way to have standardization around this on a global basis so that we're not seeing sort of a fragmentation. One of the risks we had before is there was a complete alphabet soup of different organizations trying to standardize ESG disclosure, and now there are a couple of different initiatives. The most important one is called the ISSB, the International Sustainability Standards Board, that is bringing together all these different groups to have one single approach to ESG disclosure.
I want to get into the ISSB and where we go from here, but I want to bring Todd in. First, Todd, congratulations on the new job. Just started ETF Trends, joining Tom Leiden's team over there. We've talked, you and I, many times that all these ETFs employ different methodologies, and it's a problem. The SPDR S&P ESG is not quite the same as the iShares ESG. Has this confusion taken some of the luster off of ESG funds?
First of all, Bob, thanks for having me, and thanks for the kind words. Excited to be part of the ETF Trends and database family, connecting both asset managers, index providers with end clients. They do a great job, and I'm excited to be part of it. You're right. ESGU holds companies like Meta Platforms and Disney that you won't find with EFIV, that's the SPDR S&P 500 ETF. There's different criteria that index providers use. There's different rules that go in for each of the respective ETFs. And we've got narrow-focused ETFs tied to governance, like the SHE ETF, the gender diversity, and clean energy ETFs like ICLN. So it's really hard for investors to keep up with what is inside and outside. So I applaud Doug and the broader investment community for trying to help standardize what's going on in the ESG.
Yeah, and those of you who don't understand what's going on, when we put up that the ESG ETFs, EFIV, SPDR S&P ESG, that's State Street licensing your index. That's why it says S&P, right? I want to make people to understand what's going on here and how important the indexes are. State Street, which is SPDER here, is licensing your index at this point, right?
And what happened is what Todd just described is that there's so many different types of criteria being used today for ESG. Sometimes I describe it as like the healthy food movement. Healthy food movement could be somebody that's interested in organic, somebody else is interested in vegetarian, somebody is vegan, and you could go to a restaurant that's called vegetarian, but maybe they're serving fish. Is that the right thing? So we need to think about coming up with some standardization so that when you see that it's ESG or it's a no carbon or low carbon, what do those labels mean? How are we going to make sure that the data is clear to the end investor so that they know what they're investing in, and that the asset manager is also complying with what they put on their label?
Now, Todd, demand for ESG ETFs has slowed a bit to start 2022. Obviously, commodity ETFs, inflation ETFs are all the rage right now. But money is still coming in. It's just not as much as it was before, right?
That's right. So we've seen continued interest in ESG products, but to a different degree than we saw in 2020, for example. So ETF databases traffic for the 5 largest ESG ETFs is down roughly 40% year over year to start the year. So there's less focus on ESG, but there is people who are trying to understand what is climate change and how does it affect their portfolio. And we've seen a number of products that have come to market that have Paris aligned or climate change in the name. We're finding advisors and investors want to understand what makes it into the portfolio and why. And all the more education that can be provided, the better for investors to understand what they're getting and what they're not getting.
And, you know, Doug, this is a rather fortuitous your announcement that you made today. For example, I think it's fortuitous because SEC Chair Gary Gensler, we've got some news today, has just released his long-awaited proposed rules on climate change, which would make disclosure mandatory, and he hopes more uniform in terms of what's being disclosed here. Is this a step in the right direction? How does this fit in with what you were talking about today?
We welcome this move because it opens up a dialogue between the business community, the investment community, and the regulatory community, something that we need to have so that we can work on what Todd just described as more standardization, more common approach to this area. One of the things Todd just also mentioned is climate change and the interest in that. And I think with the external circumstances going on right now with the war in Ukraine, that there's an increased interest in energy and energy transition and understanding what that means, what's the role of energy, what's the difference between oil versus clean oil versus natural gas, what's a transition type of an approach to the future of energy. It's going to be a lot of interest in that, and I think the interest is going to rise, and we're going to want to even have more standardization around what it means for investors.
Now, you publish the ESG criteria you use. I mean, you have your own criteria. You have the S&P Global ESG score methodology, right? It's on your website, in fact,
yes.
Right? Including the rationale and questions that you ask, the format, background information. How do you gather this data? Give us a sense of where this is actually coming from. Are the companies providing it? How many provide information? You know, how do you build this up from the ground up?
So today we take information from companies. We have 2,200 companies provide it to us through a very detailed, rigorous approach. They go onto our website. We have an approach with them, and they provide us detailed information. It literally takes hundreds of hours for them to complete. It takes a lot of time for them to complete it. Covers all of the aspects of E, S, and G. For other companies that are not providing us that kind of detailed information, we take it from their own websites. Companies have sustainability scores, they have sustainability reports. Some maybe there's a little bit in their 10K or their proxy. And then in many cases, we have to model it. We have to take industry standards and model what that data is. And this is one of the reasons why disclosure will be valuable, because then you're not having to model it. You're getting in a consistent way, and everybody can use it. One final point I want to make is that when you look at our scores, you're able to go not just at an aggregate score, you're also able to go down into details. If you just want to use the E part of the score, or the S part of the score, or the G part of the score, this has been another one of the criticisms of ESG scores. It kind of looks like an opaque score. You get one number or one letter, and what does that really mean? Right. We think that you need that granularity as well to really make informed decisions.
Yeah. Now, you describing the methodology, it sounds fairly rigorous. You don't have complete information, so you have to model some of it. But who is ultimately going to decide what the rules are going to be? Now, you mentioned the ISSB, the International Sustainability Standards Board. This is a new organization, right? Can you very briefly tell us what this is and why do you think they're the ones that are going to help pull everything together and bring order to this?
Well, ISSB is an organization that's been put together under what's called the IFRS, which is like the SASB at the global level, International Financial Standards Reporting Board. And they've now put in place underneath them the ISSB, the International Sustainability Standards Board. This is also taking a convergence of other types of organizations like the Sustainability Accounting Standards Board and others, and bringing them all together in a single approach to have a global standards for disclosure. So the disclosure is a great start because it means that people like us that are going to come up with our ESG scores will have the exact same data. Right. So there's going to be different scores and different types of ratings, different types of opinions. But if we're all starting with the exact same data, that's going to be really valuable.
So just make it clear, plain English, the ISSB ISSB is an organization composed of people like your organization that all have a stake in this, and you're all going to come to some common understanding. Are you a member of the?
No. The ISSB is an organization that's run by governments.
Yeah. Okay. So I want to make sure that individuals are understanding how this is going to come to an agreement.
Well, the ISSB is a foundation.
Yeah.
And it's supported by governments and individual companies. It's funded through as if it was a foundation. And it has a board of directors, which include people from the public sector and the private sector. It has a relationship with the International Organization of Securities
And is the goal ultimately, here's the standards that we are going to use? Give us a sense of a timetable. When will an agreement be reached on this?
Yeah, their approach is to start actually having standards right away. There's some standards that people had already agreed on. I'll give you an example of about 21 simple standards that the World Economic Forum agreed, that there was a large group of corporations in the World Economic Forum agreed that this should be a standard that all companies should be able to provide. It's a very small number.
Yeah.
And they're going to start trying to come up with a small number of disclosures and start building from there. The approach is what I call build a baseline and then build from there. Get some simple things out there that people would start reporting and then build from there to get more consensus and more out into the market.
Todd, I've had an extended discussion here with Doug. I want to bring you back in. Does this make sense to you? You're a close observer of all this. Is the ISB the right way to approach this? And in your opinion, is this real progress towards getting some kind of agreement on ESG standards?
So I do think this is a step in the right direction. There's a neutral observer that is helping to make sure that companies are providing the right disclosure. The SEC's role is going to play an important role. But I think it's also worth highlighting that even within the same index provider, they have different versions of ESG benchmarks that are narrowly constructed, that are broadly constructed, and there are ETFs that are tracking it that have S&P in the name or that have MSCI or other index providers, and they're going to perform differently because they're either broad or narrow in construction. So there's not going to be consistency. There are going to be different performance records for ESG ETFs, right, despite the fact that there's going to be some standardization of the underlying data.
Right. So this is very important that you can, Doug, you can have the same data and still come to different conclusions. You can also weight it differently, right? So environmental social governance, if you weight one part of environmental differently than other parts, you come up with a different index standard, a different weighting, right? It's important for people to understand that, right? What you're looking for is more standardization of
We're
data.
looking for standardization. I understand that later this week the SEC might also come out with a standard of kind of the naming conventions for ESG and sustainability funds, which truth in advertising, if you want to call it that, which means that people should be able to have the information that they will understand exactly what they're investing in, and that whoever is the ETF provider or fund provider will also be following the standards that they said they're going to follow.
Yeah. Well, this makes sense to me. I mean, I happen to think Gensler's right about this. He's been very critical of funds that say we're green or we're carbon neutral or we're whatever, and yet it's very fuzzy, the standards of what they're calling. This is that naming convention you were mentioning. Right. So that makes a lot of sense to me.
And it makes, and to what Todd was just saying, that there are different ETFs and there are different types of sustainability funds. As an example, over 20 years ago in S&P Dow Jones Indices, we launched the Dow Jones Sustainability Indices. They've been around for a long time, and the criteria that's used there is not the same that's used for the S&P 500 ESG index. Yeah,
it's certainly very different. So you think it's going to take how long? Is it actually going to be, will we see, pick a date, a year from now, the ISSB announcing international standards for ESG? Will actually be a published saying this is what we are all agreed to?
I think that within a year from now we'll have a baseline which has started to be rolled out. It's going to start in Europe. Europe is ahead of us. The Europeans already have a taxonomy that they've started discussing. And you also have countries like Japan and in the UK that have also been mandating what's called the Task Force for Climate-Related Financial Disclosure, which is a report that had been put in place a few years ago. There's a group called the FSB, the Financial Stability Board in Europe, and Michael Bloomberg worked with them on this Task Force for Climate-Related Financial Disclosure. In the United States, about 50% of the S&P 500 companies are already reporting on that. And that's now going to become mandated in some countries. So there's various approaches to climate or sustainability or ESG, but I think that the ISSB is going to take the TCFD, they're going to take other work that's been done, and they're going to incorporate it into this baseline that they're going to build from.
And let me ask you, just to get a response again. I know we asked you about Gensler before. I'm going to have him on Power Lunch in 1 hour from now, 2:15 on Monday. So I hope everybody tunes in for that. But what do you think corporate America is going to say about this? You know, there's this big thing about materiality. Gensler's insisting this is material information, and our job, one of the jobs of the SEC, is to protect investors. To protect investors, we need to have disclosure about this because it's materially important. And yet, I see pushback already from people who are saying this is beyond the SEC's mandate at all. We had Hester Peirce, one of the commissioners of Republicans, say Congress did not give the SEC authority over the economy. She had a rather scathing dissent this morning and vote on this. What do you think corporate America is going to say about this? You talk to corporate America. What are they saying? Corporate
America is going to be split on this. There's going to be a wide array of opinions. There are people that are already reporting this. As I mentioned, 50% of the companies are already doing a TCFD report. 90% of the S&P 500 companies already disclose some sort of an impact report or a sustainability report or a CR report. And they're already putting a lot of this information out there, maybe not in the same format that would be required here. But there's a couple of big reactions. One of them is going to be about the potential litigation, and they're going to have a safe harbor. Companies don't want to go out and disclose, in particular, Scope 3 emissions without having the ability to be protected from litigation against either making mistakes or it not being a clear standard, or people saying, well, I never knew that this was the total impact of your carbon footprint, and potentially having litigation. So there's going to be a whole discussion about safe harbor and litigation, and there's going to be another discussion about how expensive this is to comply with. And then there's going to be a set of companies that are going to say, well, I may be in a disfavored industry, and this could be difficult for me to comply with. There's going to be a wide array of opinions. But from my point of view, we welcome this debate. We think it's time to do it. As I said, the train has left the station. Yeah. This is what investors want. Yeah.
I want to Todd, move to a separate subject that is near and dear to both of our hearts. Last week, S&P Dow Jones Indices, which Doug Peterson runs, by the way, released its annual SPIVA report. This is the annual report on how active mutual fund managers are doing against their benchmarks, and the results were predictably dismal. 79% of fund managers underperformed their benchmarks. Over 10 years, 86% underperformed. Don't get much worse than that. Todd, is this more proof on why investors have rightly turned to broad indexes and ETFs tied to them? This is a theme we go over all the time, but every year this report comes out. It's amazing.
That's right. So it's actually been 12 consecutive years that the average actively managed large cap fund underperformed the S&P 500 index. That's the benchmark large cap managers are shooting for, and they're failing to deliver. It's no surprise that in the last 2 calendar years, a combined $400 billion flowed out of equity mutual funds or U.S. equity mutual funds. The vast majority of that has gone into ETFs that are tied to the S&P 500, IVV, VOO. It just shows you that it's hard to outperform, and it's hard to outperform because it costs more for active managers when they're trying to compete with the S&P 500 that is essentially free through the ETF wrapper.
You know, Todd, I always point out, people say, how can that be? Why are they so bad at this? And it's not really, they're not dumb, that's for sure. And I think it's important to note, you know, the academic literature has been for decades studying this. It's one of the most common things about studying financial markets. So it's important to note why these fund managers are underperforming. And what I see year after year in the research is, number one, they charge too much, the active managers, so their fees eat into whatever outperformance they have. Even if their stock pills are still strong, they're overconfident in their ability to pick winners, so there's some behavioral economics effects there. And market timing is impossible to get right consistently because you have to be right going into the trade and then right going out. Chances of doing that are very small. And finally, the opposite of they're dumb. There is really tough competition. The competition is professional, it's smart, and it's getting smarter all of the time. So I think, you know, we've known this for decades, Todd, you and I, but it's important, why I think SPIVA's report is important every year, to just keep emphasizing what the research indicates so far.
That's right. So let me hit a couple of quick points that you touched on. The average actively managed mutual fund charges 100 basis points. That's already a high bar to overcome. You can get exposure to IVV and VOO and SPLG. Those are three S&P 500 index-based ETFs for 3 basis points. And if you wanted something more targeted, value, for example, did very well. There are ETFs like RPV or VLUE, which is the iShares Value Factor ETF that charge considerably less than the active manager. You get the same exposure that you might from an active manager with that targeted favoring of value-oriented stocks, but you don't have to worry about that manager letting winners run too much. It gets rebalanced out as it should be.
And I know you don't, you didn't write this report, Doug, but you're in charge of the company that does it. And it's, to me, it just goes to the value of indexing. Again, it just keeps, this is why people figured out a long time ago that generally they don't outperform, particularly when you include the fees. I mentioned 100 basis points here. And as a result, what we have seen in 20 years is indexing grows, value your company grows, and ETFs grow because most of them are tied to indexes, and you license those indexes.
Yes. Well, when you go back to the history, in 1896, Charles Dow formed the very first index, the Dow Jones Industrial Average, which gave the markets a benchmark to start averaging and seeing what the performance was. And over the years, there's been this approach to finding indices, and the S&P 500 is now over 60 years old. And you have that level of performance for many, many years. You have the independence of an index committee. There's a governance process. They're over a firewall. I cannot get near them. They're able to look at the economy in a whole or look at different aspects of what they want to have that index perform against. And so once you have the index, it's transparent, it's been defined, you know exactly what you're buying or trading every single day. It's liquid, it has tax benefits, and it has very low fees.
Yeah, and we'll go 30 seconds on this because I get asked every time an S&P person's on. S&P Dow Jones Indices, which is a part of S&P Global, has thousands of indexes. Each of these indexes has a committee that goes on it. The Dow Jones Industrial Average has a committee that meets regularly. You are not on the committee.
I am not on the committee.
So don't ask Doug what's going to go into the Dow Jones Industrial Average, because he'll look at you like, am I on the committee? Explain that quickly.
Yeah, we have a governance process where the committee that provides the information that determines the formation of an index is behind a firewall. Their information is material, non-public information. The only people who have access to it have very strict rules about their own standards of performance and behavior. And once they make a decision, then it becomes public. That's when I hear about it.
And they meet privately. You are not in the meeting.
I'm not in the meeting.
And they meet in the dead of night with candles, some cloaks on their head, like the Illuminati, I gather. This is true of the S&P 500 committee as well, right?
All of the index committees are managed in the same way, with a committee on the other side of a firewall with very strict governance and compliance processes that we...
Just want to get that in, because we hounded David Blitzer for years. He ran the index, S&P Dow Jones, for a long time, and always the answer was the same. I can't tell you, so don't ask me what's going in the S&P or the Dow Jones Industrial Average. Doug Peterson, thanks very much for joining it. That does it for this week's ETF Edge. My thanks to Doug and Todd. We've asked Doug to stick around and talk a bit more about developments in the indexing world for 2022 and their recent deal to acquire IHS Markit. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Thank you, everybody, and have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.